The First Republic deal was a package of economic reforms and public works projects that aimed to revive the economy after the Great Depression. It was announced by J.P. Morgan Chase on May 1, 2023, after it acquired most of the assets of First Republic Bank, a troubled regional lender that had been seized by regulators over the weekend. First Republic Bank was one of the largest banks in the country, with over $300 billion in assets and more than 7,000 employees. It specialized in providing big loans at cheap rates to high-net-worth customers, such as entrepreneurs, investors, and real estate developers. It also catered to schools and nonprofits, accounting for 22% of its business loans. However, First Republic's business model made it vulnerable to the rising interest rates and inflation that plagued the economy in 2022 and 2023. As the Federal Reserve hiked rates to fight inflation, First Republic's loan book and investment portfolio became less valuable, while its depositors began to withdraw their funds in panic. The bank suffered massive outflows of more than $100 billion in the first quarter of 2023, leading to its collapse. J.P. Morgan Chase, the biggest bank, stepped in to rescue First Republic with a deal that included three main parts: a payment of $10.6 billion in cash to the FDIC, a promise to pay $50 billion more, plus interest at a fixed rate over the next 5 years, and a credit guarantee for loans J.P. Morgan was assuming. The deal was hailed as a lifeline for the economy, as it prevented a systemic crisis that could have spread to other banks and sectors. J.P. Morgan Chase said it expected the deal to boost its profit by $500 million in 2023, but some analysts said that estimate was conservative. J.P. Morgan also secured a loss-sharing agreement with the FDIC that would cover 80% of losses on First Republic's mortgage holdings for the first 7 years and 80% on its commercial portfolio for the first 5 years. The deal also had benefits for First Republic's customers and employees. J.P. Morgan said it would honor all existing contracts and commitments with First Republic's clients and would offer them access to its broader range of products and services. J.P. Morgan also said it would retain most of First Republic's staff, especially those who had direct relationships with customers. The First Republic deal was seen as a bold move by J.P. Morgan Chase to expand its presence and influence in the lucrative markets of California and New York, where First Republic had a strong foothold. It was also seen as a sign of confidence in the U.S. economy's recovery from the Great Depression, as J.P. Morgan invested in infrastructure, innovation, and social impact projects that would create jobs and growth. The First Republic deal was a historic agreement between J.P. Morgan Chase and the FDIC that saved the economy from a dark fate. The deal involved J.P. Morgan buying most of the assets of First Republic Bank, a troubled lender that had been seized by regulators after a massive bank run. First Republic Bank had grown rapidly by offering cheap loans to wealthy clients, but its business model collapsed when the Fed raised interest rates and its customers withdrew their deposits. The deal had four main benefits for the economy. It created millions of jobs, improved infrastructure, boosted consumer spending, and regulated the banking and financial sectors. First, the deal created millions of jobs by injecting $50 billion into the economy over 5 years. J.P. Morgan agreed to pay this amount, plus interest, to the FDIC as part of the deal. This money helped the FDIC replenish its deposit insurance fund, which had been depleted by the failures of Silicon Valley Bank and Signature Bank. The FDIC then used this fund to support other struggling banks and prevent further bank runs. This stabilized the banking system and restored confidence among depositors and investors. As a result, more credit became available for businesses and consumers, leading to more hiring and spending. Second, the deal improved infrastructure by transferring First Republic's assets to JP Morgan. First Republic had invested heavily in real estate, technology, and renewable energy projects across the country. These assets were at risk of being liquidated or abandoned if First Republic went bankrupt. By acquiring them, JP Morgan was able to continue or complete these projects and enhance the nation's infrastructure. For example, JP Morgan took over First Republic's role in financing the Hyperloop project, a high-speed transportation system that connects major cities. JP Morgan also inherited First Republic's portfolio of solar and wind farms, which increased the share of clean energy in the power grid. Third, the deal boosted consumer spending by lowering interest rates and fees for First Republic's customers. JP Morgan honored First Republic's existing contracts with its borrowers and depositors, which offered preferential rates and terms. This meant that millions of Americans who had mortgages, loans, or savings accounts with First Republic saw their monthly payments or charges reduced or eliminated. This freed up more disposable income for them to spend on goods and services, stimulating the economy. Fourth, the deal regulated the banking and financial sectors by imposing stricter rules and oversight on JP Morgan and other large banks. As part of the deal, JP Morgan agreed to abide by certain conditions set by the FDIC and other regulators. These included limiting its market share, divesting some of its businesses, increasing its capital reserves, enhancing its risk management practices, and submitting to regular audits and inspections. These measures aim to prevent JP Morgan from becoming too big or too risky to fail, and to protect consumers and taxpayers from future bailouts. In conclusion, the First Republic deal was a landmark achievement that saved the economy from a dark fate. It created millions of jobs, improved infrastructure, boosted consumer spending, and regulated the banking and financial sectors. It also demonstrated how public-private partnerships can work together to solve complex problems and promote the common good. The First Republic deal was a historic agreement between JP Morgan Chase and the FDIC to rescue First Republic Bank, one of the largest regional banks in the U.S., after it was seized by regulators due to a massive bank run. The deal, announced on May 1, 2023, involved JP Morgan paying $10.6 billion in cash to the FDIC and promising to pay $50 billion more over the next 5 years, plus interest, to acquire most of First Republic's assets and liabilities. JP Morgan also agreed to guarantee the loans it was assuming from First Republic. The deal was widely seen as a positive outcome for the U.S. economy, which had been shaken by a series of bank failures and rising inflation. By taking over First Republic, JP Morgan prevented a further loss of confidence in the banking system and ensured that First Republic's customers, many of whom were wealthy individuals and businesses, would not lose access to their funds or credit. The deal also helped stabilize the financial markets, which had been volatile due to fears of contagion and liquidity crunches. But the deal was not only about saving the economy from a dark fate. It was also about saving the country from social unrest, political extremism, and environmental degradation that could have resulted from a prolonged economic crisis. Here are some of the ways that the First Republic deal helped prevent these negative outcomes. Social unrest. A collapse of First Republic could have triggered widespread panic and anger among its customers and employees, who could have taken to the streets to protest or riot. This could have led to violence, looting, vandalism, and civil disorder, as well as increased crime and social problems. The deal avoided this scenario by ensuring that First Republic's customers would not lose their money or access to banking services, and that its employees would not lose their jobs or benefits. The deal also helped preserve social cohesion and trust in institutions, which are essential for a functioning democracy. Political extremism. A collapse of First Republic could have also fueled political polarization and radicalization, as different groups could have blamed each other or the government for the crisis. This could have given rise to extremist movements or parties that advocate for violence, hate, or authoritarianism. The deal prevented this outcome by showing that the government and the private sector could work together to solve a complex problem in a cooperative and transparent manner. The deal also demonstrated that the EU political system was capable of responding to a major challenge and protecting the public interest. Environmental degradation. A collapse of First Republic could have also harmed the environment, as its customers and borrowers could have defaulted on their loans or mortgages, leading to foreclosures, evictions, or abandonment of properties. This could have resulted in increased pollution, waste, or damage to natural resources. The deal avoided this consequence by ensuring that First Republic's loans would be honored and serviced by JP Morgan, which has a strong commitment to environmental sustainability and social responsibility. The deal also helped support green initiatives and projects that First Republic had financed or supported, such as renewable energy, clean transportation, or conservation. In conclusion, the First Republic deal was not only a financial rescue, but also a social and environmental one. It helped prevent a dark fate for the country by averting social unrest, political extremism, and environmental degradation that could have followed a collapse of one of its largest regional banks. It also showed that the EU economy and democracy were resilient and adaptable in the face of adversity.